The rally in crude oil cools down, but gold remains bid on uncertainty in the Middle East. Now, the US yields come lower as well, and the US dollar eases, but the US equities actually do benefit from these lower US yields and some dovish Federal Reserve comments before this week's all-important US inflation data. So welcome. This is Swissquote's Daily Market Talk. So Monday was obviously all about the tensions in the Middle East and Israel's retaliation against Hamas. Oil prices surged more than 5% at some point on Monday's trading session, not because Israel plays an important role in the global crude oil market, but Iran actually does, and the rumors that Iran may have helped Hamas plan the attacks against Israel didn't please Israeli nor the US. Iran actually denied the allegations, by the way, but a potential escalation of tensions between Iran, Israel, hence the United States, could have severe consequences for the global oil production, as despite restrictions, well, Iran could actually increase its oil exports over the past couple of months and even years, and shouldered a part of the global oil production since the Ukrainian war started, as Russian oil was banned, as you know, and the West has just little choice to let someone else actually sell its oil. And in August, for example, Iran's crude exports exceeded 1.4 million barrels per day. So it's not much compared to the roughly 100 million barrel per day demand from the global oil market, but it makes up for some of the OPEC's production cuts, for example, and well, Iran has a potential to export up to 3 to 4 million barrels per day. So pushing Iran out of the picture could actually be a nightmare for the global oil market, and this is exactly why the US is now going toward other sanctioned countries to see if there is something that could be done there, some oil that could be squeezed out there. Reuters says that the US actually makes progress in talks with Venezuela to relieve sanctions to allow at least one more foreign oil company to take Venezuelan oil under some conditions, of course. So that's where we are right now in the global oil saga. The reaction rally in oil is easing today, with the barrel of crude settling around $86 per barrel level this morning for the US crude. Brent crude, on the other hand, remains offered near its 50-day moving average, which stands close to the $88 per barrel level. Upside risks prevail, obviously. Now, many expect a further rise in oil prices toward the $100 per barrel psychological level. I am a bit skeptical regarding a sustainable rise in oil prices at a time when global economy slows and energy transition is underway. But despite that, OPEC actually raised its forecast for global oil demand and said that global oil consumption will reach 116 million barrels per day by 2045. So that's about 6 million barrels per day more than what was previously predicted. But that's OPEC. Oil is the bread and butter of the cartel, obviously, and their forecast may not be accurate. Actually, some people think that it's even a complete BS. So there, I said it. Anyway, that's it for oil. We are continuing to watch the developments, but elsewhere, the safe haven assets and, well, oil companies amass some important capital, fleeing the unsafety of the war in the Middle East. ExxonMobil shares, for example, jumped 3.5% at yesterday's trading session, and the rally in oil stocks helped the British FTSE 100 index limit its losses in an otherwise depressive European trading session on Monday. Gold, on the other hand, hit $1860 per ounce level as the US 10-year yield fell by a big chunk, around 18 basis points, on the back of increased inflows into the 10-year papers. The 2-year yield in the US slipped below the 5% psychological mark as well, but that was on the back of some dovish comments from some Federal Reserve members who actually talked at yesterday's trading session. So Dallas Fed President Lori Logan was one of them, and she actually said that the recent rally that we saw in the US long-term bond yields may mean that there is less need for the Federal Reserve to tighten its policy again. I mean, I would normally expect the falling yields in the US to mostly benefit gold, which actually did happen, but not much equities given the rising geopolitical tensions. But the S&P 500, which actually opened this week on a bearish note, rapidly recovered early losses and closed yesterday's trading session 0.63% higher. Nasdaq 100, on the other hand, advanced above its 100-day moving average, but the European Stoxx 600 index started the week on a bearish note still, because besides the war news in the Middle East and the spike that we saw in oil prices, the news that Chinese spending during the Golden Week holiday, which was last week, actually fell short of expectations. So that also hinted that the Chinese might buy less Louis Vuitton bags and less Hermes scarves, even with a cheaper euro. And speaking of Chinese not buying our stuff, well, Tesla sales in China dropped more than 10% on the year to September, and combined with the disappointing third quarter deliveries that was released last week and the price cuts from Tesla that affect their profitability and the rising interest rates, obviously, well, Tesla shares could soon successfully take out the 100-day moving average support to the downside, in which case we could actually see a further fall in Tesla's share price toward the $220 per share level. Now, price-wise, you can now buy a Tesla car at a cheaper price than an average gasoline car in the US, and, well, also stop paying for gasoline. So Tesla is still betting that when you go electric, well, you will hardly come back. But efforts to increase the market share and make people have that taste of the electric car may actually cost the company more than $1 billion per year, according to an analyst out there. More than $1 billion per year. So let's see if it works. For me, it did. In the currencies market, well, the US dollar gave back early gains on Monday. The euro dollar stabilized between the 105.60 and 105.80 level, while the dollar yen is to 148 level. More Federal Reserve members will be speaking today, and their comments could actually influence the intraday price moves in the market in one way or the other. And it is actually true that the recent rise that we see in US yields is soothing for the Federal Reserve, which is trying so hard to tighten the financial conditions in an economy that just wouldn't slow. So the European Central Bank's Christine Lagarde said recently that IMF actually cut its forecast for global growth, except for the US. So we will soon hear more details about the new forecast as IMF and World Bank hold their annual meeting in Africa this week. Now, any weakness in the global growth prospects could help take the air off the oil rally, while any upside revision for the US growth alone could actually help the US stocks recover if, of course, the dovish Federal Reserve expectations don't get smashed by some hawkish comments from the Federal Reserve members. But the most important event of this week is still the US inflation update. Keep that in mind. The producer price inflation data from the US is due tomorrow on Wednesday, and the consumer price inflation from the US will come in on Thursday. So if inflation figures from the US are soft enough, we could actually see a further relief rebound in the US equities. But gains will likely remain limited as earnings season also begins, and many investors actually expect the companies in the S&P 500 to caution about earnings trend when they report this quarter. So according to FactSet, the estimated year-over-year earnings decline for the S&P 500 is about minus 0.3% in the third quarter. So if that's the case, well, it will be the fourth straight quarter of earnings declines reported by the S&P 500 index. I know price-wise, the S&P 500 doesn't look like the companies in it are suffering much, but keep in mind that it's just because the Magnificent Seven are actually doing the heavy lifting this year, and the technology rally actually hides the cloudy picture underneath the surface. So this is all for today. I'm İpek Özkardeşkaya, and thanks for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual, and follow us on Instagram, on X and on LinkedIn for regular market updates, and subscribe of course to our YouTube channel for daily market comments. I will meet you again tomorrow, and until then, good day trading.